Recently, mortgage rates hit 8% for the first time in over 20 years.
That means kids that can legally drink now have never seen mortgage rates that high.
And with record high home prices, homeownership is more expensive than ever. On top of that, about 23% of Americans think home prices are going to drop over the next year. But will they? When the interest rates go up, mortgage demand drops because some people just can no longer afford to buy a home. According to CNBC, between October 2022 and October 2023, mortgage applications dropped 22%. With the number of buyers dropping out of the market, why haven't we seen prices go down?
Great question.
Along with home buyers disappearing from the market, we've also seen a huge reduction in the number of home sellers putting their house in the market. In Middlesex County this year, we've seen a reduction of between 25 and 27% of homes for sale. With 22% of buyers out of the market and 25 to 27% of sellers out of the market, we still have this tug of war where we don't have enough homes for the number of buyers who want them.
Part of the reason people are in hiding is because of the low interest rates. Over 71% nationwide have a rate of less than 4%.
Even if a home seller wants to move, sometimes they just can't afford the double whammy of getting hit with a higher interest rate and a higher price tag.
If a homeowner is thinking of cashing out and renting instead, that could be more expensive than a mortgage payment.
Just between June of 2022 and June of 2023, the average rent for a 2-bedroom in the Boston area went up over 14%.
Some headlines have been talking about how foreclosures are on the rise, and that's true because the foreclosure pause has ended.
Some analysts expected that once foreclosures started up again, that we would see a bunch of listings hitting the market, but that hasn't happened. When you compare today's foreclosure numbers to 2019, which was a great market by the way, we're still well below those numbers and we're nowhere near the numbers that we saw during the Great Recession.
Taking a 20-year look back, foreclosures are actually at an all-time low. That's because people are sitting on a ton of equity. Almost 70% of Americans have either no mortgage or 50% equity on their home.
That means that if a homeowner does come into a distressed situation, they can cash out and sell their home versus going into the foreclosure process.
The reason we saw so many foreclosures in the housing bubble of 2008 is because home values dropped and homeowners were then upside down on their mortgage.
Those homeowners could not sell out of a foreclosure. They owed more money than the house was worth, so they didn't have a lot of choices. So right now what we're learning is that when banks actually qualify borrowers for their loan, we have fewer homeowners get in trouble and fewer foreclosures. As the rates go up and homeownership gets more expensive, what we're seeing is sort of a tale of two housing markets. The higher end is definitely seeing a little bit of a slowdown and not a buyer's market, just a little bit of a slowdown. In the lower price brackets, we're still seeing crazy bidding wars. There's a ton of competition because buyers are getting pushed into those lower price brackets as the rates go up. But there are some pockets of opportunity. Some things that I've seen recently that I have not seen in a long time is sellers accepting offers with home sale contingencies before the buyer has actually sold their home. Haven't seen that in a while. More home buyers are being able to do home inspections. And just overall, we're seeing more negotiation and more leveling of the playing field.